Welcome back to another Stock Market Open live stream. Today, we have retail sales coming out in 4 minutes. In 4 minutes, we'll be covering retail sales. We'll see what's going on with the consumer. We'll see what's going on with retail sales advance month over month. We expect those numbers to be negative 0.1%. Retail sales X auto to be negative 0.1%. Retail sales X auto and gas to be up 2%. So we're looking for minus if you include energy and autos. And then if we exclude both, we're looking to be positive 0.2%. We're looking for, at the same time, initial jobless claims, 220,000, continuing claims, 1.879. And then we'll also get import and export prices. Import prices expected to be negative 0.8%. That's basically importing deflation. And then we're looking for export prices, actually potentially on a month-over-month basis of negative 1%. So also exporting deflation. So it's like we're trading deflation is what's expected. So we'll see what happens. We've got Tesla up about 64 basis points here in the pre-market. The Q's up 41. Tesla, PayPal up 1.22, Trade Desk up at $74, 161, Enphase up another couple percent here in the pre-market. Oracle's back at about 102, it fell below 100 for a brief moment there. Palantir's trying to get back up a little bit. Apple's at 197 still. Let's go ahead and look at a sort on these just to see how we're starting the day here. Open Doors trying to push with Redfin up the highest, about 8 to 6%. Nothing really that red. I mean, Hawaiian Holdings still sitting around that $13, a little higher than actually where I remember it. But anywho, okay, so let's get that data coming out in a minute here. And I also I'm pretty excited. If you haven't seen the announcement yet, a lot of you have been really liking HouseHack. I was actually kind of surprised with the overwhelming response of people who liked HouseHack. So if you kind of want, what we're going to do is just all of the research that we do and a commentary or whatever. It's all going to be at ehack.com. So you can go there and you'll kind of see like what time it was posted and what some of the news is. And you can even kind of click on the attachments or whatever, if there are attachments, or sometimes we'll even do highlighted. So for example, here's a piece that we're working on and you can see some highlighted attachments. You can get basically all of our research and commentary and everything at ehack.com. It's kind of just a free, and it'll always be a free repository of data. So go check it out. All right, here comes the data. Retail sales. Oh, wow. It all comes in with a little bit of a beat here. Retail sales advance month over month. It was not negative. It comes in at positive 0.3. Not negative on X Auto. Comes in at a 0.2 positive. Retail sales X Auto gas comes in at 0.6. Stronger than expected. Control group beats at 0.4. Initial jobless claims come in better than expected at 202 versus 220. Better than expected. Import prices only fall 0.4% rather than the 0.8% we were expecting. Petroleum for import prices actually gained 0.2% rather than the 0.2% fall we were expecting. Import prices year over year were negative 1.4 rather than negative 2.1. How is it so off? And then export prices negative 0.9, which was close to the negative 1 we were looking for, and we were looking for 5.2. We got negative 5.2. So let's try to distill this for a moment. Basically, the economy is actually doing stronger than expected here. Not only is it doing stronger than expected on a sales basis for November, but less people are losing their jobs. Now, that's good. The 10-year Treasury was down to about 3.95 before this data. It is moving up a little bit on this data. Some people, I think markets might try to digest this as suggesting, oh no, the Fed's going to have to do more. But none of these numbers are really scary in terms of inflationary. And B, they actually somewhat reiterate the idea that maybe we can avoid a recession, which that's really interesting because this is like the best case scenario of what you want. You would want retail sales to come in better, and you would want joblessness to come in less bad, and you would want price declines to still be present, which we're seeing. So all of that is somewhat relatively similar to this dare you say the soft landing phrase. However, I don't know if the market will solely see it that way, as it could also send the signal of, whoa, 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 all this premature dovishness and rate cutting expectations, you're going to have to go right back to cutting. This is too strong. Let's see what they're saying over here.
8 out of 11 months now. 8 out of 11 months had a negative sign, and then these instances, negative signs are considered good. Now, let's go year over year. Import prices, minus 1.4, less than a minus 2.1 expected. And if we look at month over month, down 0.9%. That's about in line with expectations. And finally, export prices year over year, down 5.2, exactly as expected. That means 10 out of 11 months are negative. That is indeed a good thing. If you summarize all of this, all of a sudden, retail sales and claims really matter. We see yields jumping all the way up to 398. 398, the low water mark for this move intraday is tonight, 3.93%. We see that at 3.97. We're down about 4 basis points, and it underscores how quickly we went from 5% to 4%. And I'll leave you one thought, Mike, the word asymmetric. I found something that Powell said yesterday, very important, with reference to higher for longer. He said, we don't want to be seen as hanging on too long, meaning for that higher for longer. Asymmetric, I don't ever remember them being worried about hanging out too long when it was too low for too long.
That's
Mike?
absolutely right. No, for sure.
Well, remember, inflation was too low back then. They were trying to stimulate the economy back then.
You know,
and I'm talking about like 2018, 19, right?
CNBC NRF retail monitor X autos and gas was 0.7. So this surprise is not a surprise to those who are paying attention to our index reported on Monday. But this is a strong number. Rick, could you remind me again? I can't find it, the control group, because I thought you said it was a surprise. And I think that's going to flatter the GDP outlook for
percent.
Yeah.
Up 0.4%, double expectations.
That's a good number, and that's for the month of November. So the story that we've been telling, we also had Bank of America on earlier this week with their high-frequency tracker, is that holidays got off to a good start. We'll see. It was interesting to me that electronic appliances were down 1.1%. Not surprised to see building materials down 0.4%. We've heard trouble from Lowe's. We've heard trouble from Home Depot. Gas station sales, though, down big, but it was clothing and apparel did quite well. Sporting goods up 1.3%. And non-store retailers, those are your internet folks, 1%. Food service and drinking establishments up 1.6%. Consumers are still spending, and then we're not getting the weakness we thought we'd had in the jobless claims numbers. Mike, I've been contending for the last couple of weeks that some of the bump up we might have seen in the jobless claims numbers could have been related to the strikes, not the striking workers. They don't get jobless claims, but the folks who lost their jobs because workers were striking. Perhaps they've come off the rolls. We still are at a somewhat elevated level on continuing claims, but 202 is a very, very modest number here. And this bump up we had to the 220, 230 level seems to have gone away, at least for the moment. So still a pretty good job market, and consumers are spending, and that's going to flatter the GDP numbers.
Yeah, Steve, stay with us. We're going to add another voice to this conversation. Michael Gapin, head of U.S. economics at Bank of America Global Research.
We'll come right back to them. Let's take a look at the actual advanced monthly sales and retail report here. Here it is. So we've got, let's see here. Want to explore some of the details. Here's the actual sheet. And what we're going to look for is usually what I like doing is I like looking at the seasonally adjusted, since that's generally the quoted figure right here. So we're going to look at the adjusted column, and we're going to look at this column right here, which to make it a little bit easier, usually I like to just kind of draw a little box over that. And then, of course, we can do the same thing on a percentage basis, which makes your life a little easier. So that way you have a nominal basis and then a percentage basis. So this is going to be month over month. This is going to be year over year. All right. So let's look at those really quick. Furniture, month over month actually up, but year over year down 7.3. Oh, that's interesting. It's almost like, is furniture coming back? Oh, no way. I couldn't believe that. That could be a little bit of a leading indicator. Look at that change right there. Is it time to go Restoration Hardware? I wonder how their stock's been doing. That's actually very interesting. Could it be that furniture is coming back, or is this just a holiday thing or something like that? Wonder how Restoration Hardware. They're up 12% yesterday, 2% on the pre-market, and look at their stock. They've really come off some of those crazy COVID highs, pretty low on the fibs. So that's interesting. Then you've got electronics and appliances. They're negative versus the growth year over year. Then we've got building materials, still negative. Groceries up 0.2. Health and personal care. That's like your Ulta right there. Still growing. 10.9% over the year, 0.9% on the month. Gas down. There's clothing still growing. 1.3 on the year, 0.6 on the month. Sporting goods coming back a little bit. Let's see here. Food services and drinking places. I mean, it's positive for people spending money locally. General merchandise stores, department stores, non-store retailers. It's going to be like your online. Although Etsy wasn't too happy yesterday. Okay, and then we look at some of the nominal figures here. I want to see the growth. Specifically, let's look at that. Where is home furnishing? Furniture. There we go. So furniture's right here. And on the adjusted basis, relative to last year, oh, here it suggests on an adjusted basis, we're actually down. How interesting. So on an adjusted basis, we're down. But on a percent, how's that? How weird. Because that's going to obviously help guide revenue for companies like this. Furniture and home furnishing store, November 2023 advance from October or November as a preliminary estimate, sitting negative year over year, positive month over month. Okay. Let's see if that's the case. Positive month over month. Yes. Negative year over year. Yes. Okay. There are the numbers. So there's that. Is that potentially, although you were even higher in September. So you've got a little bit of a dip you had in October. Kind of a little bit of a mini V shape. Not that. Yeah, there we go. There's your V shape. Okay. Well, that's maybe a little bit more nominal than thought. Okay. Interesting. All right. Let's keep listening in here for a moment.
The September 18th meeting next year, or even the end of July meeting, you're really moving out too far. What we should really learn from Fed Fund futures is that the markets are sort of like children. You give them one piece of candy, they want 5 pieces of candy. Fed Fund futures have now erred on taking the unofficial stance of the Federal Reserve, and the unofficial stance is that they're done and eases are coming, and they're going to run with it and take it a little bit farther. So that's the dynamic to pay attention to. Believe me, if 1 month from now we get new inflation data that reheats, you're going to see the markets react very significantly in Fed Fund futures from the front, and then it log jams all the way down. So that is the nervousness about a market that's trying to price these meetings where every month has a contract that affects the next month. So one thing changes, everything changes. It's like parallax. If you have a laser aimed at the moon and somebody just nudges it or sneezes in the room, it moves a lot. And that's what you need to worry about when you tie your fate to Fed Fund futures contracts way down the road.
Yeah, as I mentioned earlier, I mean, back in the spring, they were projecting.
He's such a salty bear.
It is pretty sensitive to changes. What concerns you, if anything, about next year in terms of the economic outlook, Michael? I mean, we have oil prices have been really cooperative. Almost everything has moved in the right direction, frankly.
Yeah, literally since late October, early November, everything's moved in a very favorable direction for the soft landing camp and the Fed's outlook. I would say maybe what's concerning is that rarely happens and that rarely continues in a straight line fashion. And I do think we need to be, worried about the first half of the year, and maybe the labor market does soften too much. But from a policymaker perspective, what to do?
Not what we saw today, at least, fortunately. But that is true. If the labor market goes down, you got problems.
First half of the year, we are,
then you're back into 2007 and 8.
Fiscal policy and slowdowns in business spending and fiscal drag, and that's kind of where the negative could come in. But as you mentioned, virtually all the data has been very conducive to a soft landing.
All right. See if it continues. Michael Gapin, thanks so much.
Thank you.
Rick, Steve, thanks to you all.
Yeah, I mean, it's so interesting to me. It's now it seems like the bearish argument is, oh well, those might be good numbers, but we don't know if they're gonna last. You nudge that laser a little bit and it's gonna be like, whoa, that's a big change. This reminds me of Mike Wilson, which we actually put a piece up on HouseHack from Mike Wilson yesterday. Mike Wilson's suggestion, businesses think they're going to be able to raise prices. And if businesses think they're going to be able to raise prices based on the surveys we're seeing, inflation's going to come roaring back next year. Of course, he doesn't mention in the survey what percentage businesses actually think they're going to raise prices. Like, are they going to raise prices 0.5%? Because if they do, who cares? Who cares if they raise prices 0.5%? That's less than 2%. Businesses are welcome to raise prices all the way up to 2% theoretically. But of course, that's not mentioned. So the one thing that destroys all of this, obviously, I mean, there's of course the risk that inflation reanimates. It's not really being seen anywhere. The biggest thing that really destroys this is the destruction of the labor market. If you destroy jobs, you're done. As soon as you destroy the labor market and you create this self-fulfilling prophecy of layoffs, where you get negative, if you get negative employment growth, panic about the jobs market, then everybody else starts laying off, then you get a great recession. That's worse than 2002. I don't know if it'll be worse than 2008, but you get a recession very quickly. So you don't want to destroy the jobs market. And that's why I think that Jerome Powell is actually, dare I say, dovish right now. One of the reasons he's being dovish, in my opinion, is because he realizes if they keep going too heavy-handedly, they will destroy what's left of the labor market. Like, for example, look here. If you take the liberty of going over here to HouseHack, I want you to see that right now we have 6 25 basis point cuts priced in. In addition to that, in September of 2007, the Federal Reserve cut rates for the first time with 25 basis points rather than with 50 basis points rather than 25 expected. Actually, I'm sorry, not necessarily a first rate cut, but rather they hit negative jobs for the first time, while at the same time having fears about inflation, with inflation running 3.9 to 4.1%, and the mortgage crisis brewing. And it was really eerie kind of reading it because it sounds so similar to today in everything except the mortgage crisis part. And so that's where a lot of people are like, yeah, we just haven't found our breaking point yet. And we're fortunately not on negative jobs. We're still booming on jobs. But short of not having a mortgage crisis and negative jobs, everything else in the article sounded very similar. Oh, we're going to be able to, the economy's still growing. It's not going to be like 2002. This time is different. Inflation's fine. But we're paying attention to it. It's a predominant concern. Look at it. I highlighted the whole piece here. It's so eerie almost. Gold is a safe haven. The dollar dropped. as the Fed cut, stocks rallied. And the dot-com bubble was different because that was a stock bubble. But then again, we have this dubious mortgage crisis going on. It was actually a really interesting kind of comparison. And this was written back in 2007. And look at that. Producer prices fell by 1.4% in August, much more than expected. Boy, it just sounds so freaking similar to today. But again, the big thing is jobs. So, like, you just have to pray that jobs hold up. So as soon as that rolls over, you're screwed. And I think that's why we got a dovish Fed yesterday. So again, see this at ehack.com. Yeah, I almost said eHawk. eHack. Check it out and let me know. Let me know what you think, if you like it. I don't know. If nobody likes it, I won't do it. But the plan is that that's going to be free forever. So it's just a free like repository of our notes that I think is kind of cool. So we like that. A lot of people have been asking for that. Like, hey, you guys do all these notes anyway and all this research, but you can't make a video on every freaking fart in the markets anymore because, you know, people have less time. So is there a way you could kind of put it all in one place? And we're like, sure, we'll do as you ask. All right. Let's see now how the treasuries and the stonks are reacting. Somebody here writes, I truly enjoy it. Simple and straight to the point. Props to you and the team. Thanks, man. Appreciate that. Yeah, it's here. Vahid here says, love eHack. It's awesome. Thank you. Thank you. Yeah, really, really the goal here is, somebody here, solid data. Nice. Yeah, a big fan of just providing as much value as we can there. Oh, I really want to separate the idea of what's data versus what's opinion. So that way we've done that with the little emoji system we've got there, which is very easy. It's 2 emojis. Mostly it's like, if it's data, it's a check mark. If it's opinion, it's the little halo. And so that makes it very, very straightforward, I think. All right. Let's see what this person's yapping about.
Only because we have heard from wine enthusiasts, other places, that they are paying more in terms of drinks, and that is definitely driving up ticket sales. Do you get any access to that?
Yes, we do. So for the restaurants that we're seeing holiday spend, for example, so that would include, you know, the spend that's happening in the next 2 weeks, Valentine's Day, Mother's Day. The spend increases for special occasions about 15% versus normal. So we do see that people are spending more. They're really prioritizing their discretionary dollars on special occasions while they dine out.
How is that compared to last year, special occasions like holiday last year?
Yeah, it's roughly the same. Actually, we are seeing a slight increase, even if you look at that increase in spend. But this year, it's coming in even higher.
What are your concerns? What are your thoughts when it comes to the economy? I mean, we've been talking all day about how the Fed is now seeing a softer economic landing as a real possibility. What do you think?
I think it's great if there's a little bit more stability in the upcoming year. Inflation and rising labor costs and supply costs is terribly disruptive for restaurants. It's an industry that historically runs on very razor thin margins. So disruptions like this can be catastrophic to their P&L. You know, but I don't know. I think this year there was a lot of uncertainty on the economic front, and we saw diners continue to prioritize going out to eat, continue to prioritize the experiential. And so I think even in a potential downturn, that demand is going to hold. And if things get better and that uncertainty subsides, hopefully we'll see even more dining activity happen.
Debbie, one of the huge issues for restaurants over the last several years since the pandemic has been being able to find enough workers for the restaurants. Where do things stand on the labor front, just in terms of finding people and then what you have to pay those people to come in?
It continues to be really hard. In October, the hospitality industry lost about 7,500 jobs. And there's a lot of issues at play here. One of them is tipping, for example. It's been a very controversial topic, and I'm sure you can understand why. From a service, I hope we can all agree that a service worker should be paid a livable wage. And what's uncertain?
Optimus Robot, baby, that'll get paid a livable wage.
Is it the restaurant or is it the diner? So I imagine that this is going to be a topic that we're going to continue to hear about next year as well.
All right, Debbie, want to thank you. Debbie Sue.
No, it actually probably won't. In fact, that those robots, when that happens in the future, it'll be really interesting because one of the things I was thinking about, we were speculating about this a little bit in the Tesla podcast yesterday, or the Tesla podcast. That's funny because we do talk so much about Tesla. The Meet Kevin podcast and Mikey, we were talking about this idea that Tesla robots, not only can they work theoretically, like basically 23 hours a day, you know, you get to take a break and probably charge at some point, but no workers' comp. So if you put them on tasks that that are you know, risky from a workers' comp point of view, you actually mitigate your expenses substantially. So very, very interesting. Valentine's Day plus wine equals baby. Let's see here. DoorDashers pick their own food up. What is this? Hospital doctors are easy. General practitioners are not. I'm not exactly sure what that means. Let's see here. Optimus Robot Gen 2 looks great. Yeah, I think for some of the shots, they probably wore some copycat harnesses. You know, it's kind of where you have a person hooked up to the goggles with all the wires, and then they do, you know, this kind of stuff. And the robot mimics it. But there are definitely some movements there that the robot was doing on its own. That was very impressive. So, yeah, I do think, I mean, if I had endless money, which I don't, but if I had billions of dollars sitting around and I was bored, I'd probably make a robotics company right now. I wouldn't go into this OpenAI bullcrap. I would, I think there's a limit to that benefit, you know, 10%, 10, 15%. But yeah, I would go into robotics. I think that's where really some big damage could be done in a good way. You know, so anyway. Okay. What do we got? Looks like the market went positive after that data. You'll notice what I wrote over at HouseHack. I wrote, look, if the jobs market rolls over, we're screwed. Until then, we want better sales, weaker prices, and less joblessness. Today's data gave us all three of those. That's great. Stronger economy, less joblessness, and prices that aren't running away. You'll notice as well that has the little emoji with the little halo hat or whatever. So like I said, and you could do this throughout the day, and we're literally going to update this every day throughout the day. You go to the page and you just look at the little hat guy or whatever. There's our commentary. And then the rest is data. So you can kind of separate, like, where's the opinion and where's the data. I think that's so important. And there's like, there's basically no clickbait because you don't click on anything. Like, you just scroll. So it's impossible to have clickbait. I mean, the only thing that you could potentially click on would be like when I link like, hey, Atlanta Fed real GDP comes out later today. You know, you can do this on your phone if you want. Oh, okay, really, Kevin? Let me click on it. You know, and then it takes you to the Atlanta Fed real GDP now page. Like, it's straight up. My goal is to just have that populating forever. And it's always free. No, like Tucker Carlson, $9 a month or any of this kind of crap. I was thinking about, like, it was actually one of the reasons I talked about this on the podcast. Yeah, I'm motivated to do this. So I'm like, dude, if everybody has to pay $9 a month to get perspective, you know, they want the Wall Street Journal perspective, pay $9 a month. You want the Times, get $9 a month. You want Tucker, $9. You want Ben Shapiro, it's $9. Hey, at some point, like, people are just going to get pigeonholed into one of those, and then you never get competing perspectives. Yikes. That's scary. I don't know. All right. Focus on what we got going on here, which is Tesla's almost up 1%. QQQ's up 50 bips. Enphase almost up 4%. Okay. So rally mode appears like it wants to continue. And actually, Treasury yield's falling again. Wow. They popped off a little bit there when the data came up. They came up about 3 to 4 basis points, and now they're only up about 1 basis point, back at 3.96. Are you able to post all the research PDFs on there? Yes. Yes, actually. So anytime I post something that has research included in it, they will be there. So for example, if you go here and you look at the Morgan Stanley, like look for Mike Wilson, right? Morgan Stanley on Fed rate cuts. Look at this. Morgan Stanley's full PDF right here. His whole thing with our highlights. We added some of the highlights, right? This is the part he was talking about. Businesses are increasingly optimistic they could pass on price. And I'm like, well, that doesn't tell us what percent they're willing to raise that, right? So this is like Mike Wilson being a little, Mike Wilson-y again. So I wrote a little summary. Mike Wilson releases his bearish response to the FOMC, believes the market is rallying due to rate cut expectations, looser financial conditions. He's bearish, though, going into 2024. He thinks that earnings revision breadth remains negative. The weak PPI will actually hurt businesses in 2024. You'll notice I posted that yesterday at 3:39 p.m. So, and it's there. It's easy for you to find. ehack.com. So simple. Look, I even put a picture of Barbara over here. The pictures I put up, by the way, mostly I try to, that's a picture I took because I'm like, I don't want any, licensing problems. So I was talking about London, and I'm like, I got a picture of London in my phone somewhere. It happened to have an Etsy ad on it, which I thought was kind of funny. Anyway. Okay, so let's look at the 5-year break even. It's actually going up a little bit. Excuse me. It's like a tiny little bit of these in the mornings. It's like early in the morning and then at night, tiny little bit of this annoying occasional cough. It's like, come on, man. Just being around too many kids or what it is. So anyway, the 5-year break even is actually up at 2.17. And I want you to look at this. Here we go. Look at this. Because J-Pow is starting to price in rate cuts, ironically, the break even actually went up, which is kind of cool. Because it's basically the market reacting and saying, oh, no, that could actually cause inflation to go up. And if then you look at it on the year chart, it's like, oh, well, that's not really that bad. So it's kind of cool. Kind of cool. Stop kissing kids. Kevin smokes cigarette. No. It's this nice, small, easy to read website. Very well done. The only thing smaller than it is Tattooed Chef's market cap. Oh, that's dirty, man. Take a look at this, by the way. Somebody's complaining they want a dark mode. Look, I can't please everybody with the color, so just change it yourself. There's your dark mode. What happened to the HDMI? It totally died. Okay. Let's try to plug that in again. And let's try that again. That's not what I meant by go dark mode. Just go black here completely. There we go. So just press the little reader button, right? Show reader. And then you could actually click it again and you could change it. So you could change it to dark mode, gray mode. You make it whatever you want. I'm pretty sure Android has something like that too. I was actually testing it on the Pixel yesterday. Although the stupid fingerprint thing, I need to reset up again because it always doesn't seem to want to work on the Pixel. But I would imagine that Android also has some kind of thematic feature. Or does it just sort of use what your computer wants? Oh, theme. Dark theme. How does this work? Oh, that's for the keyboard. Okay, well, I'll have to play around with this. But anyway, I'm sure there's a way you can change it for an Android as well. You could also just get an iPhone. That's always a good solution to solving Android problems. Sorry to the 50% of people I just upset. It's a rivalry, okay?
Showed a level of flexibility that is unusual for Fed Chief, usually like to just leave it that way and just see it, how many people get hurt and then take action. And he didn't do that. You know, David, there's an element of this man which is unpredictable, even as he looks like he's completely predictable.
Does that make him exciting?
No, he's definitely not exciting, but he did take a shot at the Bears.
Yeah, somebody here says, how do you search keywords on eHack? You use Command Find, Command F, or the search feature on your phone. Like, why do I have to make it? It's built into your phone. If you're a believer in massive rate cuts, why not go long 2s rather than 10s? Yeah, well, so what you're saying basically is, I mean, you're taking like the Bill Gross argument that the 2s are going to fall more than the 10s when the curve re-steepens. This is true. I'm actually, the bond exposure that I have is A, TMF, and B, we have a ton of bond exposure at HouseHack, which is great. JP Morgan actually hit me up. They're like, bro, you want a credit line? And I'm like, well, that depends what terms you got. And so, yeah, they're being pretty cool. But anyway, yeah, look, why would you go with the 10s? Well, you would go with the 10s if you want to lock in the higher yields for a longer term. If you want more of a delta quickly, you might go for the 2s. But obviously, the higher yield on the 2 isn't going to last as long as the 10. So it sort of depends on everyone's individual purpose. Oh, look, Bill Gross. It's like they're listening to me. And then they put it up.
Yield curve. Great day for the curve. Regional banks, mortgage rates up 4 to 5. Kicking butt.
Oh, well, Shotton and Ryan said, are you going to come to the Niners-Eagles game? At least he, even though the stock was down huge, at least he showed some respect.
D-Block the Observer says Kevin hates Jeremy. It's sad. That's actually not true. I actually like Jeremy. I texted him the other day. I didn't hear back, but no, I like him. I think he's good. Like people thought I didn't like him because like we had the tattooed chef drama, and he was upset I drew the support line at 0. But what can I say? I mean, like it made for a good Millennial Money episode. It was fun. I enjoyed that. It was a little late in the day, which is funny because like now we're doing the podcast. I will say, like, the podcast is really interesting because it's that roughly same kind of time. And I'm like, oh, I'm tired. I don't want to work anymore. But doing it in person actually like wakes me up again. And so it's like the opposite effect that I used to feel with Millennium, where it's like you're on Zoom. It's like, oh, I'm dead. Anyway, so let's see. Okay, Jim's browser search history is dangerous. Oh no. Kevin, do you think any of the Optimus movement was like that? That'd be fraud, misleading though, right? Why would it be fraud? They never told you. They never said that when the robot was doing, like, the big movement that I think was totally rigged was this part where it's like moving all its fingers really fast. And it looked really smooth. It was a great actuator demonstration, but they never made you think that it was moving on its own. I mean, maybe you thought that from the video, but it's like if they had a little caption that's like the robot's doing this on its own, but then it wasn't, it was a human controlling it, then that would be fraudulent. But they didn't say that. They didn't say anything. They just showed you the video. It's like, those are some cool actuators you got, is the first thing I thought, because I'm just assuming it's 100% controlled in that one scene I'm referring to. I do think there were uncontrolled portions that they showed in that video. And again, I don't think that's bad. It's just kind of a classic euphoria that comes around the marketing videos over, oh my gosh, this is so amazing. It's like, well, let's put a little bit of realism on it. And then it's probably a little less bullish, which is okay. I'd rather be realistic. Let's see here. Let's see. That's called lying by omission. Well, again, are you demonstrating what the bot can do? Because if the bot can move by doing this by itself, like it's actually moving that, you're just doing it with a controller that you're wearing, then it's not it's not actually lying. Like the bot is actually doing that. It just happens to be copying what a human is doing, right? So I suppose it depends. What is the consensus? Like, do people think it's all going on as I don't know. That's very interesting to me. I think you could probably debate that either way. That's very interesting. But let me just be very clear, okay? I love what I saw with the Optimus. I'm not looking at it going, that was all its own movement. I 100% do not believe that. There were absolutely parts that were remote controlled on there. And again, I don't know that that's necessarily a horrible thing because it demonstrates the actuators and the Tesla's proprietary build-outs. So again, it's just a sort of a realistic look at it rather than only a rose-colored glasses look at it. Okay, so I hear you. I want the financial upside for a robot that can replace 1/5 the workers. I would say it's close. Yeah, I don't know about being close for 1/5 the workers. It's maybe close for, like, I don't know, people unloading boxes for containers. Like, I'd be concerned. But honestly, if I were unloading boxes from containers, I would use this as the motivation, that kick in the butt I've been waiting for, you know, to get a license or do something that I can provide some more value in. You know, go right for eHack. Come intern for us. Oh, by the way, pretty much all of our interns that we hired, actually, I shouldn't even say pretty much. All of our interns that we hired have gotten their stay offers, and let's just say their pay like 5x'd, which is really amazing. We purposefully do a thing where, you know, you start out low and you prove yourself, and then now, you know, you go from underpaid to potentially overpaid. Although I think, you know, they're actually earning what they're doing. But it's amazing. Like that's how it's supposed to be. So, but it's really cool. We're really happy. We're in a great place with every angle we're working on. So it's very fun. So and that should be the goal of a business, is to be able to pay very well. So, okay, Bitcoin, we're at 42.5. Oh yeah, so we did drop off of that quite a little bit here in just the last little bit. We were at we had a high just a little bit ago here of, actually, let me go to the day chart. Yeah, we've kind of been rotating down here over the last 4 days. Let's go look at BTC together here. BTC USD. Yeah, if you wanna be an intern, you could always email us at jobs@meetkevin.com. So jobs@meetkevin.com. So anyway, this is virtual doesn't work for us. Not at this point. It's very difficult to do virtual remote. You know, we've got one dev right now who's virtual, remote, but they're pretty close. They're like, you know, an hour away from us. Anyway, so here 42.4 is where we sit with BTC. Yeah, look at that candlestick drop you had over here. Now, what's interesting is that candlestick drop actually came with data. This is when the data came out about 40 minutes ago. So this was retail sales and the jobs numbers and everything. Very interesting. All right. I mean, it's recovering a bit from there. I feel like that's kind of the same heart palpitation the market had. And right now, the 10-year Treasury yield is really only up about, 1 or 2 basis points from where it was. So really nothing's moved after those retail sales numbers. It seems like things are relatively stable as they were before. So see how the market opens up. Let's go look for some more research and listen in over here.
Shoplifting than we were pre-pandemic.
Data published by the Council on Criminal Justice shows the average monthly reported shoplifting rate peaked in December
How about
of
New York?
19.
Except for New York.
No, New
Yes,
York's
you got to strip out New York.
Yeah.
Do you?
I went to CVS last night and I wanted to get some cough syrup. And I asked the guy, I said, look, I really don't want to pay. said, I see everybody else not paying. They're using, I've been watching the people in self-checkout. No one is paying. They're using it and they're not paying. And he said, I think it's fair that you pay. I said, but no one else. I mean, come watch these self-checkout. This self-checkout was one of the biggest jokes ever. Great piece in Atlantic. And that all has to go because none of those people were paying. I felt like a fool.
Well, that's why a lot of them are doing a U-turn on self-checkout.
They have to.
Yeah.
I felt like a loser.
What stores are you turning on self-checkout? Is that just like in higher crime areas? Because I don't know. I'm seeing more and more self-checkout, not less. I mean, in California, you can't self-checkout on alcohol or like, certain things. But other than that, it seems like self-checkout, like you go to Target, for example, they're just like tripling down on self-checkout. Or you look at McDonald's, that's another one. It's pretty obvious the direction a lot of these areas are going. So I don't know where. Is this like an inverse Kramer thing? I don't know. All right. Let's see here. What does JP Morgan have to say in terms of outlook this morning? We're going to pop this open here. So let's see JP Morgan's outlook. All right, here we go. What do we got? Internet. Let's see here. Outlook this morning. Okay, they're doing some chat. No recommendation changes with this note that we increased price targets for Google and Uber and reshuffle the top lists to Amazon, Uber, Google, Match. Some of these other here. What'd they remove? They removed Facebook and Booking Holdings from their top picks after significant outperformance. Okay. Let's see here. Wireless, positive subs. Ooh, trading desk conference call, 8 a.m. today. Wait, that should be going on right now. Oh, that's not trade desk. That's their trading desk. Okay. Oh my God. I saw what I wanted to see. I'm like, what? Trade desk getting what? No. ECB's Lagarde says we did not discuss rates at all. We'll have a lot more data in 2024. Oh, I'll update that into eHack really quick. Did not discuss rate cuts at all. Did not discuss rate cuts at all. More data coming in 2024. Waiting specifically for wage data. Update. All right. So okay, what is this? Booking says travel activity continues to rebound after suffering a setback after the Hamas attack. Twitter's ad sales slumped 2.5 bill. Palantir renews digital transformation partnership with UniCredit. Fine. Sup, dudes. Okay, boring. So next, let's see. Let's get another one here. So that's JP Morgan. I don't care about American Tobacco. I need more. I need more research. How about we look at Barclays? Commentary on the FOMC. Yes. That's what I want. I want to see what Barclays has to say. Uh-oh. I like the title as a bull. I don't know how everybody's going to feel about this one. Somebody here is writing, how about an eHack app? That is in development. So if you, Trade Desk is in Ventura. You're right. Exactly. It's kind of cool, huh? My goal is to be bigger than Trade Desk in Ventura so we can have the biggest company in Ventura. So I just have to grow the businesses that we're doing to exceed $36 billion. I'm on it. I'll let you know when I get there. A little bit of optimism is a good thing. December FOMC, but yes, we are going to make an app for eHack. But for now, just use the web app. It's really good. Just go to eHack.com. You'll love it. It's totally free. It's going to be free forever. And I'm actually really excited about using it. I think it's like I'm trying to put myself in your shoes as a watcher, and I know you like listening when you can, and so we'll have the videos. But there are other times where you're like, you just want to read. You just want to read a little bit about the news, and you don't want the clickbait or the bias or the bullshit, basically. And so these are going to be the facts, but also, you know, with opinions segmented out. And so it's really just trying to help people in sort of the new 2023-ish, 4-ish environment we're in. FOMC kept policy rates unchanged, softened slightly. It's tightening bias. Latest SEP indicates 3 rate cuts. Okay, we already know that. They added the word any. We were surprised by the FOMC's reluctance to push back against the easing of financial conditions. So was I. They really did not care that financial conditions were easing. Oh my gosh, I'm making up words. We now expect 3. Okay, so they're matching the Fed, expecting 3 rate cuts. However, we place an upside risk as the recent path to financial conditions easing may boost growth and ultimately result in stalling deflation. Well, remember, I think this was what even these like institutions get wrong. Remember, a better economy. Okay, what am I going to write? You should already know this. A better economy equals. So in other words, does not equal a guarantee that disinflation will stall. Right? Remember that. The reality is a functional capitalistic economy should see inflation fall when it's growing. It's crazy. I don't know why that's so hard for people to understand. HouseHack is the best thing you've done so far. Oh, well, all right. You must really like it. Let's go with that. Nice. Yeah, HouseHack.com. You just refresh it throughout the day. Literally just check in like every hour or whatever, and you'll see little updates pop up. It's kind of cool. Optimism about inflation opens the door to rate cuts as widely expected. Blah, blah, blah. Okay, whatever. As expected, the FOMC retained a tightening bias. Okay. Pat yourselves on the back. Downward revision to the dots undoubtedly reflects the lower inflation projections. Yes. After having seen inflation fall significantly in the face of very strong growth and an unusually tight labor market, the SEP continues to feature a soft landing scenario with immaculate disinflation. Wow. They sound bitter. Why are you mad, bro? While the economy surely benefited from a significant improvement in supply conditions over the past year, which likely significantly lowered inflation pressures at the same time as the labor market remained tight, it remains to be seen if such positive development will continue into the next couple of years. Yeah, that's like, is that the best argument you got right now? Bears are like, it's not going to last. Well, yeah, of course. I mean, at some point, there'll be a crash again. This is kind of boring. Our Fed call. In light of today's news, we change our rate call. We now expect 3 cuts in 24. And the market's pricing in like 6, man. Let me look at this. All right. Let's go to December of 2024. Wow. Holy smokes. Right now. Hold on. 0.0. Did I do that right? Oh, come on. There we go. Okay. The market is pricing in a 39.4% chance. 39.4% chance that in December of 2024, we are going to see rate cuts of, well, basically we'll be down to 3.5%. That's crazy. So that would mean since today we are sitting at 5.25 on the low end, that would be 3.5. That would put us down 7. There's a 39.4% chance. Wow. That's actually wild. Think about what the market's pricing in right now. That's pretty wild. So December 2024 projection is a 39.4% chance of 7 rate cuts priced in. And then if we go, let me see here. If we go to 6 rate cuts, we're at 75.7%. Wow. 75.7% chance of 6 rate cuts. And then there's actually even a chance here of, let's look at this. This is a 7.6% chance of 8. Oh my gosh. 7.6% chance of 8 rate cuts. Wow. Wow, wow, wee, wow. All right, let's listen here for a moment.
Obviously allows us to manage free cash flow and hit our return sooner. The MAX 8 is a wonderful aircraft. I'm very optimistic. It's really Boeing, but I'm very optimistic that we'll see the MAX 7 certification sooner rather than later. And we need that aircraft, and it's a wonderful aircraft.
I want to thank Bob for coming on the set and Phil for visiting us.
You know, I'm shocked they didn't change the name of the MAX. I remember, like, I don't know, it was like a year ago. I was on a 737 MAX, and I asked the stewardesses, I'm like, hey, does anybody ever look at these seat back pockets and realize they're on a MAX and get afraid? And they're like, yeah, we try to turn those around so it's not like advertising what plane model you're on, just for that reason. I'm like, wow, I can't believe they didn't change the name. That's kind of crazy, huh? Somebody here says, the great reset is around the corner. I always hide some coffee in an emergency stash just in case one morning it happened. What? If you see the executive on TV, sell. That's actually funny. That's interesting. That you gotta like, you're going cynical that they're basically, they got to pump the stock for some reason, huh? I like that. I like that cynicism. That's the kind of jade that's good. You got some real jade over there. I don't know. I'm pretty jaded too. Okay. So look at that. Enphase up 4.11% on the pre-market following a 7.8% rally yesterday. NVIDIA is still sitting at 480. 35 bips on the Qs, almost 69 bips on Tesla. BTC stable here, 42.5. Restoration Hardware is up a couple percent. Looks like the Russell 2000 is trying to push in the morning as well. We pretty much have nothing red. And we've got some nice big fat green over here at Open Door at 8.62 with Redfin at 7.36. Yeah, not bad. Charge Point 4.58. All right. Okay. So let's see here. 5 minutes to the opening bell. Oh yeah, I forgot to mention, we do have a little price increase happening on the Meet Kevin website later, probably 11:59ish tonight. It's the intro course. A lot of people love this to get into the course member live streams. If you want to be part of the course member live streams or just get the lectures, deep effing value here, and new lectures coming out at the end of the year. Check it out. Go to meetkevin.com or email us for bundle coupons in case you want to bundle up with some of the other amazing things we've got here. Just send us an email at staff@meetkevin.com or just click the little bundles button since we've got some bundles here. But yeah, we'll take care of you today. All right, so let's look at what the suits are saying. Lagarde tries to push back a little bit about talk about a Fed, this Fed pivot talk. Mostly suggesting that no, they didn't talk about rate cuts. Hawkish economic data gives yields a small boost. Not really. I don't think those yields are holding up at all. I mean, I guess 2 basis points could be a small boost, but I mean, that's almost flat in my opinion. All right, so that's not really news. Okay, fine. So no news there. What do we have? I'm going to look really quick at polls. Real Clear Politics, latest polls. And We have a national here. General election, Trump v. Biden, tie per Economist YouGov. Oh, NPR just put Biden ahead yesterday by 1 point. But on Tuesday, Morning Consult put Trump ahead by 2. And then, do we have another general election? Yeah, Wall Street Journal puts Trump ahead by 4 from Saturday. Yeah. Oh, it's going to be a juicy election year. All right. Nobody's seen an election year quite like this. Powell pivots towards a happy new year. Yeah, no kidding. I do feel like it was sort of like a Christmas gift. Like, thanks for hanging in there for 2 years of hell as we, bring out the vacuum cleaner. Yeah. Okay. What else we got? Let's go look at, let's see if we got some more info from the suits here. So we checked out Barclays. We could go. Ooh, Rabobank usually has some bearishness. I need some bearishness. Yeah. Here we go. Let's go. Let's get some. Let's give the Bears some respect. I love the Bears. I'm just not a bear. I can still love them, even though I'm not one. I love women, but I'm not a woman. But I'm only allowed to love Lauren. But Anyway, you get it. So the key event yesterday was the Fed's rate decision, as the FOMC seemingly pivoted. Like, listen to the frustration. It's like, it's like they're snarling. I guess you could say they pivoted. I guess we'll go with pivoted. Actually, I love that. As the Fed seemingly pivoted. Come on, man. Like, how blunt do you have to be that was a pivot? Jeez, Lord. Looking at the market this morning, we're pissed. The 10-year yield has plunged nearly 20 basis points since the decision. 2-year, a little over 30 basis points. Markets are now pricing in 6 cuts for 2024. We're knocking on the door of 7 now. As our Fed watcher notes, the formal statement was a bit more dovish. A bit more by adding any rate hikes? Come on, man. They called peak, bro. Economic outlook was downgraded ever so slightly. And although inflation remains elevated, it added that inflation has eased. Importantly, this led to a downward twist in the dot plot with an additional cut than we were expecting. Yet clearly the key driver of the sharp reaction by the market was the fact that Powell decided not to push back against market expectations for rate cuts. It's true, he kind of doubled down on their idea. And we got to hit the bell. But I want to come back to this bear piece because this one sounds jaded. All right, so we'll see what he's so pissy about after the bell.
Margins keep going up.
Yes, and Raj, look, Fred Smith built a great company. Time for new blood. Raj is taking it into overdrive. This place called Drive. I like this stock very, very much.
Let's get the opening bell and the CNBC Real-Time Exchange. The big board, it is the event. Celebrating its sponsorship of Bryant Park, one of the best places in New York City, and the Winter Village there.
Bro, that's like 90% green. Let's go. It reminds me of 2021. It's not a bubble. No, or it is. I don't know. But I'll take it. It feels good today. So F your puts, F your shorts, and
just close the fucking door. Close the door.
And even though I'm a licensed financial advisor, real estate broker, I'm becoming a stockbroker this
yourself.
There.
Is that clear?
Gotta stop pushing the wrong button here. Anyway. All right. So what do we got? Qs. Trying to figure out a direction on the Qs right there. It's a fight. You got Tesla. Oh!
Gain the lead.
Nice. Good candlestick there. Restoration Hardware is trying to candle up. Come on, Qs. You can do it. Yeah. There we go. Push it. Trade Desk up 1.61. Nvidia. Oh my. Oh.
Gain the lead.
Yes. Enphase up 10 freaking %. Let's go. Etsy 19 bips. Broadcom's up a little bit. Palantir's up a couple %. You've got Open Door up 13%. Robinhood's up 2%. Let's see here. There we go. There's Enphase. Solar Edge up 8%. Matterport. Hey, the small caps. Let's go. 4.6%. SoFi up another 4%. Let's go. SoFi. Wow. So Enphase now up 12%. Let's go. Keep pushing it. All right. Let's go over here. So let's see what the bitter bear has to say. Oh, the BB. The bitter bear. Is the gig over for you? Sorry, it's bad. Don't make fun of the Bears, Kevin. Don't make fun of the Bears. The BB. The bitter bear. Okay. So let's see what they have to say. We still have to respect the BBs. You know, I had a rule. No, I'm not going to say it. Bill, if you're watching, Binions. Anyway, this basically erodes the importance of any near-term inflation data that would put a point to inflation still above the target. Nick Tiermos tweeted that Powell said some members even changed their mind halfway through the meeting. No. And now that's taking data dependency quite literally. That's not what was said. This is incorrect. I was there. I listened to it very, very, very clearly. Incorrect. Some members changed their forecast before the second day of the meeting. I guess you could say that's mid-meeting. Halfway through the meeting. I mean, halfway through the meeting makes it seem okay. All right. The implication is I see what he's doing. Okay. The implication here is wrong, right? It was the morning before the second day's meeting. Morning before second day's meeting, before the deadline for SEP, which is around mid-morning, 12/13/2023, right? So that it makes it like it's that bitterness that makes it seem like they're being flip-floppy, but they just incorporated the latest data in information that wasn't due yet. You know, it's kind of like if you have a homework assignment and then you find out like the answer to 23 is actually C and you wrote B, you know, you quickly like erase it and you put it in. It's like you'd be stupid not to. Like it's not due yet. And it's not flip-flopping after the fact. It's you got data and you changed it. Like they're casting this a little bit nonsensically, but whatever. Did they not watch the meeting? Like, did they have to listen to Nick T in order to get, like, actually, this implies they didn't listen to Powell's meeting, because if they listened to Powell's meeting, they wouldn't be surprised that Nick T tweeted this. Like, you're only surprised that Nick T tweeted this if you didn't watch the meeting. No bank will only start cutting when inflation hits their target. ECB sources suggested ahead of the meeting that core inflation being structurally below 3% would be a necessary but not sufficient condition for the discussion of rates. Recent inflation data were much softer than expected. Will the ECB, like the Fed, accept this? Well, the Fed wants to cut beforehand. You know, we already got what the ECB is doing this morning, and they're like, yeah, we're not cutting yet. Not there yet. Their inflation's running a little hotter. They actually, if you go to ehack.com, you could see what the ECB said this morning. If you're not using ehack.com yet, I farted this together yesterday, and I hope to keep it going forever. Very excited about it. So I hope you appreciate the hour that went into web development here. Yeah, thank you. Thank you very much. But anyway, it's fantastic. Like, I think it's a great resource. But anyway, so ECB this morning, 525. What do we get? Did not discuss rate cuts at all. Inflation averaged to 2.7% in 2024, down from 5.4 in 2023. So yeah, you've definitely got a little bit more inflation pressure in Europe than you have in America. Recall that the ECB took into account spillover of higher U.S. rates when they concluded that their rates were not necessarily over. If the EU were fully consistent this time, they would surely have to hike now. Don't call me Shirley. Shirley. What's that line from Airplane? Anyway, this is really interesting. He's taking this argument that, like, well, you know, they were relying on hikes in America. Well, if they're going to soften, then they need a hike, right? Man, he is just begging the banks to hike. It sounds like desperation. At the same time, verbal intervention probably won't do much to counter market expectations. ECB refuses to give forward guidance. I mean, that's not true. The euro spiked right after Lagarde said they didn't discuss rate cuts, whereas Jerome Powell's like, yeah, we're talking about it. What's this guy's name? Then I'll know I have a resident bear to go to at Rabobank. Elvin de Groot. Wait, that's actually kind of cool. That's like what's that guy's name? Groot in the movie? I Am Groot. Dude, his name's literally Groot. Holy smokes. Breaking. We have found the $14 bear. His name's Groot. I'm not reading that wrong, am I? Is that the same spelling as Groot?
When I first interviewed Stefan Bancel, it was at
Oh, Groot means big in Dutch? Oh, that must be ironic for him. Oh, no, don't go there, Kevin.
Cancer. And I said, I'll believe it when I see it.
I know.
And then he did it.
And then he did. Stefan Bancel was a guest on Squawk Box this morning talking about this latest trial. As you can see sort of the headlines on it right there. Take a listen to what he thought.
Now at the 3-year mark in the same study, we're showing almost 50%, meaning the two curves are differentiating further as time goes by.
What?
And that's really exciting because not only we think it will have a huge impact on melanoma, it's 1 in 2 people. Think about the number of lives that can be impacted, number of people that can be saved and live a normal life despite a diagnostic of cancer.
Very excited.
Yeah.
Now we know cancers, people think that cancer is all one disease, and it's not. But I just think that this is something that tells me that the original franchise is finally here. And that's something that's worth more than just where the stock is. But David is great.
Whatever. So, okay. Retail sales, we talked about those. See what the other suits are saying. Obviously, we're going to go to the course member live stream soon, but let's try to get a little bit more data before we do. Let's see what we can do. So we've got ECB rate cuts for March look like a stretch. That's at least the argument here from the suits. So Europe a little bit behind the Fed, but they'll catch up soon enough. Lagarde tries to push back on Powell's pivot a little bit. All right, whatever, big deal. All right, let's get the 10-year right now just to see how the bond market's moving. 3.9, 6.2. Jeez, Lord. Excuse me. The 2-year is down 10 basis points, so that's going to be more of a steepening of the yield curve. The 2-year is down to 4.38. We're still inverted though by what, 40 bips here, something like that. Yeah, 41.5 bips. So we'll evaluate how this yield curve moves. Remember, usually it's the steepening of the yield curve that's the painful part. And we had a lot of steepening between July, when we were literally in July, we were negative 104 points. And through November, well, actually up to the end of October, we ran all the way up to like negative 25. So like we almost went back to zero, but that was a really painful 3 months. So like you have a very recent example of the pain of what a steepening yield curve could look like. All right, there we go. Okay, link for the course member live is out. Confirm if I'm right, please. The 10-year and the 5-year finally reverted. Oh, well, yeah, I mean, we could figure this out very quickly. So the 10-year is 3.950. That used to be my area code. Okay, and then the 5-year is 3.90. You are correct. The 5 and 10 have, I wonder when that, let me see, 5-10-year spread. I could also just look at the spread and look at it on a chart, but you're right. They're uninverted right now. Oh, well, they've been doing this dance since October. So they've literally been bobbing up and down around the zero line since October. So it's just kind of been like this. I think it's crossed 0 like 4 or 5 times now. So short of pulling up the screen. No way, dude. Come on, man. Like what? This morning I talk retail sales are going up in furniture, and then I show Restoration Hardware at the bottom of the Fibonacci, and before I can do my analysis on it, it's up 7%. Oh, come on. I just stop talking about this stuff. Like that. That's funny, man. So I wanted to study them today. It's moving too fast. Notice we're not hearing from Janet Yellen lately. Well, I actually don't think that's true. Because, see, if you go to ehack.com, I believe if you go to ehack.com, you use the Command F tool, and you type in Yellen. It says here, Yellen says we should have no reason for investors to feel nervous about U.S. debt. And then Kevin's opinion. Remember, the Treasury Secretary is a political position, so pro-Biden is a must. Eventually, the bill will come due. Soon? We don't think so. Eventually? Probably. Maybe 100 years out, though. So notice this is like an example of how eHack can work for you. It gives you the fact, and then it separates the opinion, so you know the difference between the two with what we're doing at eHack. So again, throughout the day, just look at eHack.com. We're all going to be working on it as a team. It's a really cool website, and it's totally free forever. And it's just like benefit to people that subscribe, or tell anybody about it. I don't care. I mean, it helps it grow. Tell your friends about it if you like it. You know, maybe you don't like it. Then give me feedback. Okay, let's what we're gonna do. We were done with the bear guy. Dude, it's up 8% now. Stop. Come on, man. How am I gonna do my fundy on Restoration Hardware? Come on, man. It's up 2%. When I saw it in the retail sales. Okay. Charge points up 15%. It makes sense for a company that's going to go potentially bankrupt. Enphase, on the other hand, up 11%. Let's go!
Gain the lead.
Rivian up 8%. Okay. They're getting better. Still losing a lot of money, but I mean, they're just financing from shareholders. Oh, we did actually get some stuff go red. Lululemon, after some of those retail numbers this morning. MasterCard, Visa, McDonald's. Okay. All right. That's fine. That's fine. Let's go see. Where's Trade Desk, 4% on Trade Desk. John Deere, 4%. What's John Deere doing right now? You know, let me play this. I'm gonna look at sticks while we press this. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage the ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. Oh, let's go Intel, baby. Intel, come on. $46. Let's frickin' go. This is my favorite value growth play. I generally don't do value because I think a lot of value is a value trap. But I'll tell you, if you want a good PE ratio and good potential EPS growth, so a low peg, do your research on Intel. I'm exposed to it, so yes, I'm biased. Just do your own research on it, okay? Look into Intel and understand the stimulus money that they're getting from the government to build these chip factories. Same thing with stimulus money for like an Enphase. But anyway, I got to go. Remember, folks, meetkevin.com. Price is going up on the gold course today. $420. $420. You get lifetime access to the course member live streams. The fundamental analysis, everything we do in there, the Q&A. Like literally, people have been in there since 2017, and they're still coming to live streams. It's crazy. So anyway, love you all. We'll see you soon. Bye.